Hello guys, for this video clip, we will figure it out how to record the consignment accounting. The point number one is that when to recognize revenue. The answer is that when consignee notifies the consigner of sales. It's not a sales when the consigner delivers goods to the consignee, because the consignee is just agent to hold and sell on the consigner's behalf. They are just represent of the salesperson, right? Salesperson. We can just assume that they are salesmen, but outsourcing salesmen. And then number two key point is that transportation cost. Transportation cost in a normal transaction, transportation cost in freight out is the transportation expense. It's not capitalized. It's not included in the inventory value. But in the consignment accounting, transportation cost from the consigner to consignee can be capitalized as inventory cost, because do you remember how do we value the inventory? Right, we include all the costs before selling, right? Because the inventory by definition is goods for sale. So until the sales point, we include all the cost. But when consigner delivers goods to consignee, that definitely there is some transportation cost, but still before selling point. So even though that is the transportation cost of freight out cost, we can capitalize as inventory cost. Okay, we just assume that this is still freight in costs before selling. Keeping in that mind, let's practice. Consignment goods, consigner transfer consignment goods to consignee, and then consignee has sold these goods to customer. 1,000 units at $100, and the consigner delivered consignee, the inventory freight out cost, even though that is a freight out cost, is still capitalized, right? So freight cost $30,000 should be included in the inventory, $1,000 unit, and allocated, right? So 1,000 times 100, that was the inventory value, plus $30,000 is now new inventory value. And then when the consignee sold the inventory to the customer, the sales, now out of 1,000, 600 the units sold at $200. Definitely is higher than the inventory value per unit. $200 per unit is the selling price. But consignee also should get some commissions, right? Commissions on behalf of the consigner. This consignee is outsourcing a salesman, right? So the consignment commission is 20%. Let's do the generalizing the consigner's transaction, number one, number two. First, in the consigner's transaction, capitalized freight cost $30,000. So we can capitalize by putting this amount, $30,000, into inventory and cash out $30,000 transportation cost. Again, this $30,000 freight cost is capitalized cost as inventory, should be included at the end of the day. Okay. Transaction number two, when consignee notified the 600 unit sold to customer. So to record the sales, 600 inventory sold. Now finally the sales. How much is the sales? That's correct. 600 times 200. 600 unit times $200 selling price. So the sales 120. And then the consignee should transfer cash to consigner. How much is the cash? How much is that? Right? 120,000 times, except for the commission 20%, now 80% we should put on it. So as a consignor's perspective, they should receive $96,000 except for 20% commission of sales. Now, another point is how much cost of goods sold they have to recognize as an inventory cost sold. That's the point. That's the point, right? So the inventory value, except for this freight, was 1,000 times 100. 1,000 times 100. And then we include $30,000, the freight cost. Freight cost. That is a new inventory. Is that correct? And then there is total inventory. Now, how many inventory we sold? That's correct, 600 out of 1,000. 1,000. So we got 78,000, the cost of goods sold. Again, the inventory cost per unit, if we started from the inventory cost per unit point of view, 100,000 plus 30,000, that is the total inventory value divided by $1,000 total inventory number of unit. So we got 130, but we sold 600, so 78,000. This is the sum of these two equations. Okay. So cost of goods sold, and then inventory, the asset out. So we record on the credit side, the asset down. Then, is that correct? Are we missing something? It should be balanced out, the debit and credit side. So what do you recognize? Commission 20%. That is the commission expense. Commission expense. That is part of expense because we give this 20% like salesperson commission expense. So we record 20%. How to get it? The total sales times 20%. So 24,000 is the commission expense, so that we can match between debit side and credit side. Now let's put that journal entry into the balance sheet and income statement for the financial reporting. The inventory, now inventory here, 30,000 minus 78. Okay, I understand that there's no negative inventory on the balance sheet, but we just assume that we have had inventory earlier, 1,000 times 100, but we just ignore the prior transaction before this year, before these transactions, so that just in order to understand this, the purpose of this study, we just put only this related transaction. So inevitably, it shows the inventory as a negative value. Okay, the cash now minus 30 on the credit plus 96,000. So 60,000 is the cash amount. Then let's sum up this two. Then the total asset is 18,000. I don't think we don't have any other the balance sheet account yet. Now the sales here, we made the sales 120,000. Then cost of goods sold, negative 78,000, that reduced the sales. Then commission expense is 24,000. So we put it. Then net income, the sum of this, the income statement accounts are the $18,000. They should be accumulated in the retained earning. So the total liability and equity exactly the same as total assets, so we balanced out. Okay. Now next point is the consignees transaction viewpoint and the report on the financial statement. On the transaction 1, when the consignor delivers goods to the consignee, how do you recognize? How does consignee recognize this transaction? Okay, there's no value actually. It's just the transportation from the consignor to consignee. So there's no transaction related to the exchange of any money or the value. Okay, just the different place from the consignor and consignee. So we don't have any journal entry. So no entry. No entry. What about transaction number 2? Now, finally, this consignee sold the goods on behalf of a consignor to the customer, 600 unit out of 1,000 at $200. So how do they record? When they receive cash, from the customer, the total amount, right? How much? 600 times 200. That is the cash amount received from the customer. Then difference is sales, but actually it's not the sales. It's not the sales because that goods is not the consignee's goods. The title has not been transferred to the consignee, right? So we cannot say the sales. Instead, this consignee earned the money from this commission. That's correct. So we use commission revenue. Commission revenue is indicated in the income statement. You can get this hint here, right? So that commission revenue, how to get it? Out of $120,000 received from the customer times 20%. Got it. So until the payment of the rest amount of money, except for 24,000 commission revenue, that is the payable. That is payable to consignor. So this amount should be transferred to the consignor. So there's recognized 96,000, exactly the same as the cash received here, the cash received by the consignor. So it should be the same. When the consignee paid this the $96,000 to the consignor, now cash out from the consignee 96,000, and then we can take this out. We can remove the payable because the consignee paid it out. So $96,000. Okay. Then let's report this journal entry to the financial reporting procedure. Do we have inventory? No. The consignee doesn't have any inventory. Now the cash received from the customer and cash paid to the consignor, so $24,000. What about the payable? Okay, let's go step by step. The liability before the payment to consignee and consignor, 96,000 minus 96,000 when the paid out. So payable, there's no amount. It's not matched out. It's not still matched out because we haven't finished the reporting process to the income statement. So the commission revenue is for the consignee. And cost of goods sold. Do you have cost of goods sold? No. Again, that is not the consignee's inventory. So we don't have any inventory cost because title is not is not of the title for this consignee. So there's no cost of goods sold. So the net income exactly same as the retained earning. So we matched out. So that is all the financial reporting procedure in the consignment accounting. Please keep it in mind that the consigners, when to recognize the revenue or sales, what account do you have to use, and the freight cost is not the transportation expense cost, but the part of inventory cost that can be capitalized. Okay, see you in the next video clip. Bye bye.